Welcome to Sandjack TV, woo woo woo, with your host, Nathan Aragon, the professor with the mostest, bringing you on this latest edition of Managerial Accounting, Chapter 15. Yes, we are going to go over job order costing and analysis. Now, we're basically going over the basic simple forms of job order systems. In Chapter 16, we actually go over process systems. So, there are the big two ones of knowing as cost accounting, which looks at certain costs, especially the big three: direct materials, labor, and overhead, and separates them out to certain products and services. So, we're taking this concept and we're basically breaking them out. As you can see with the chart right here, there's certain advantages and disadvantages of job order systems. Basic stuff we want to know is that they're going to usually be custom and individual jobs. So if you want to think about those, that's pretty much custom jewelry, invitations you find on Etsy, or anything you find on Etsy, or Pinterest, if you want to use those apps. Buildings, for one, because certain buildings require different customization than others. Probably unique machinery to do stuff. Cruise ships, cars, anything and everything you can customize. Even kind of fast food, because it is a job order system where basically they don't make it till you order it. They are known as heterogeneous products, which means again that they're different between each one. They have low production volume and a high product flexibility. So again, they don't order the products until the order's in, or they don't actually use them until the order's in. Basically, this is also known as just-in-time. And a real famous company that dealt with just-in-time was Toyota. So they're the ones that almost pretty much invented that, where they don't order the materials until they're almost done, or basically once the job is there. We have the low-medium standardization. Again, that's basically they don't do anything, they don't have anything ready until the job comes in, then they know exactly what they need. Compared to the process system is more individual process, goes through the same thing, same product, so it's very homogeneous. And it has a high production volume. This is assembly line stuff. Low product flexibility, they can't really change anything, and very high standardization. So again, job ordering is more custom, process is assembly line. Now, there is products that can be on both sides. Companies do use both job ordering and process due to their departments, but we're just focusing on one company that just has job ordering. So, what is a job? What's a job lot? Well, jobs are basically any product that is customized. Any activity that we're doing, that is known as a job. A job lot is when we're making more than one unit of specialized product, usually like 20 or 30 or maybe 60. Maybe we're making 5 different cars at the same time. All these are known as job lots. We just put them all together. In the textbook we're using, they're going to bring an example called the Road Warriors. And like I know, some of you are either thinking of WWE, well, good old famous tag team, or you're thinking of the Mel Gibson awesome movies, Mad Max. Both good, ain't what we're using right now. In fact, this example of Road Warriors is all about customization of entertainment systems and security devices in cars. So they're going to take cars and they're going to put DVD players or certain different security systems. All these take customization because they're going to fit the customer needs. So they may have a police car one day which has a different need than a civilian car or a civilian truck. Maybe one just wants the DVD player so the kids will be good on those road trips. You know how it goes. So we're going to really look into how job order and costing works with this example. Right here we do have our graphic. Now this is basically the summary of the chapter. What's going to end up happening with our process. So our cycle is this. We have to get our materials, our overhead and labor. We're going to figure out the direct materials and direct labor. Those immediately go into what is known as work in process, like from the previous chapter 14. So this is our WIP. Those two get immediately go. Overhead though is again indirect materials, its actual overhead, and indirect labor. These go into overhead cost, which later we figure out which one goes to what job. But still it ends up in the WIP inventory account. Once the job is complete, like these three right here, it moves to finished goods inventory. Once it's been moved from finished goods inventory and sold, and technically delivered this part, but really sold, it then moves to cost of goods sold. So we're going to look at the flow of this. It's going to be pretty much the same cycle as we go through with manufacturing cost all the way to cost of goods sold. Again, it's basically that formula that we've already done in chapter 14. We're just basically break it down now into its proper journal entries. So right here with our notes, again, direct material and labor will be applied directly to jobs in progress. Any amount requisition and will appear in work in process, manufacturing overhead, due to that lack of traceability. Remember, we can't trace anything in overhead to a particular product, but we know since it's dealing with the factory, it's part of production costs. We will have to allocate it to the various jobs at a predetermined allocation rate, which of course we'll discuss later in this video. When the job again is complete, it moves to finished goods, then cost of goods sold. So when we look at these job lots, you actually get to use software in the real world, which is awesome. Mostly the big three right now is SAP, Oracle, and the brand new one that's is coming over is known as blockchain. These three will have the software. They'll be able to help you out. All we will have to do is know how to read them. Well, for us, road warriors have this job cost sheet. These basically reflect the materials, labor, and overhead that has been applied to a specific job. So we're looking at job number B15. These are all the requisitions that they did. So all these are different parts that materials that they requisitioned from raw materials, the direct labor tickets, and the overhead rate. Again, we're going to get into this later in the video. But as you can see, right now, they say they had a total of 600 from the date started to the date complete, 1,000 there, and then 16,000 in applied overhead. These job cost sheets help us actually determine which jobs are becoming more profitable or which ones are becoming bad. Then we get to see, well, what made that happen. So we actually do look at these job cost sheets quite a bit when there's something that just doesn't look right. Again, it's all about traceability. Accountants love that. I mean, we love paperwork in one way because we can explain ourselves if something bad happens. It's like, here it is, what's going on here. So again, there's our job number, the address and customer, who it goes to, what was the job. Apparently it was an alarm system on a Ford Expedition. Date promised is March 15th, date started, and date completed. And it's going to Malibu. Awesome. Good Miley Cyrus song. I actually like that song. Alright. So let's get into the accounting entries. In this course, your journal entries are going to fall into chapter 14, 15, and 16. Mostly 15 and 16. And this is going to get our basis of what's happening in our cost accounting. First off, with custom, first thing we always have to do is we have to buy our materials when we look at direct materials. So we're going to purchase that first. And we're going to keep using the Road Warriors, going for their tag team championships. So the Road Warriors had to buy about $2,750 in raw materials this time around. They probably already had some, but we're not going there. So we have we have to buy $2,750. For this fact, we're going to usually use accounts payable. We tend to put the materials on credit until we actually sell the product. And once we sell the product, then we actually pay off a lot of our payables in the company aspect. But it's just easier for companies and very quick to do it on credit. So you're going to see accounts payable being used a lot more with raw materials when you're working in a job cost market. So with this, again, they will have an actual document that will come out. And this document is when materials are purchased, we track them in our accounting system until they're actually used for a job. Here we actually see the report. This report came from the warehouse. We received 2 units. This job for B15 requisitioned 1 of those units to be used for their job. Notice this is the requisition number. If I look back here, I should actually see it right there, R-4705. Everything can be traced to themselves. So again, we can tell what job, what they used, when we bought the products, everything. Well, once we get all our jobs together and know exactly what direct materials we have, we may actually know all the materials requisitioned, but the direct, this one would total all of our jobs, and we know it's about 1,800. Now, again, indirect, we don't know which jobs it's going to. These we can go specific. We love direct because it makes things easier later on. So, once we have the direct materials, we then pull this out of our raw materials account and we take it and put it into work in process. So when we put it into work in process, our WIP inventory account, I'm just going to stick with WIP. WIP is easy. Alright, so once we stick it in there, into our WIP, we're going to debit that WIP and we're going to credit raw materials. Again, raw materials is going out. It's now being used in the production process of that product. So now it's part of the WIP or the work that's being done currently. Okay? Indirect we'll get back to because that's part of overhead. So we'll get back to that later in the videos. So right now, our direct, this is it. It's all we have to do after we've purchased our material. And again, you're going to see this kind of requisition form that happens for materials. All this tells us is the job number, the material stock number, the amount that's been requested, on what date. So again, we can trace everything. So if inventory starts appearing missing, but we have one of these documents, it lets us know who requested it, and we may want to question that person. Again, reason why we have a lot of these documents is to have that internal control to avoid fraud. So once we have the materials, next let's move to direct labor cost. Now, when we're doing customization, we should already know how much direct labor is associated with the jobs, because basically we already know it takes this amount of time to create this job. When we know this, we can actually put the assembly line workers all into direct labor, and we simply again told everyone that we know we can trace, and then we're going to do our journal entry again to work in process. So our WIP account is going to be debited, and then our credit account this time is factory wages payable. Again, what we're doing right now is just starting the jobs. It's like almost placing a bid on that job. This is how much it's going to basically cost us. So with this, we have not paid our direct labor yet, so we still owe them money. So this is going to go into factory wages payable. So later on, when we actually pay them, we actually of course do the basic one where we debit the wages payable and credit cash. So with this, again, we're not dealing with indirect just yet. We're about to get to it just a little bit. But what the total? It's 4,200. That's where we got the 4,200. Now, we do keep track of our employees, mostly using time tickets, which of course indicates how long are they punch the clock. We basically keep everything together with the hourly wages, so we should know exactly how much direct labor was used on the product. For indirect, again, we know salaries, we know maintenance workers for the factory, so those we actually put in overhead again. Remember, we have to know exactly if it's going to be indirect or direct. If they touch the product, if they work on it, direct. If they don't, and they just basically are there for the factory, one in a managing position to make sure everything's right, or basically our janitor for our factory, those are just simply indirect labor. So this brings us to what is basically our bugaboo. This one is the more complicated one, and that's overhead. Direct materials and direct labor, again, we can trace and we can get specific amounts. Here with overhead, we don't have that good, lucky kind of thing. So we actually have a cycle that ends up happening. One, we separate the predetermined overhead rate. That's at the beginning. We apply estimated overhead to specific jobs, and then we record actual overhead as it goes on, so during the period. And then at the end of the period or end of the year, we tend to adjust overhead. So step one, how do we predetermine overhead? Well, we take what we believe our estimated costs are going to be for that job, our overall overhead cost. So again, we're taking the overall and divided by the estimated activity base. So what will be our overall activity base for all of our jobs? So managers get together, they make decisions using whatever costs are basically up to date, and they set the estimated overhead cost, since we don't know what the actual is going to be. Next, they take the activity base, which basically is chosen on which overhead costs are based on. Now, this basically does have a cause-effect relationship. So, our most popular ones with job costing for activity bases, we're going to probably use direct labor hours, or we're going to use machine hours. 9 times out of 10 though, I will probably tell you it's going to be closer to direct labor hours. They're just a little bit easier to figure out with overhead. So the predetermined overhead rate will most likely also be expressed as a percentage of the activity-based cost. Then it will actually be shown as a decimal. But this is mostly when both of the overhead and the activity base are in dollars. We can do percentage. Sometimes we can't, but most likely they're going to be in dollars. Don't worry about it. It's going to pretty much be in dollars. Step 2, we're going to apply the estimated overhead to specific jobs using that predetermined overhead rate. Now, when a job incurs any volume of the activity base, the volume is actually multiplied by the predetermined overhead rate. So, to calculate the amount of overhead to apply. In our example right here, we are going to go that if we know that there's going to be 1,000 direct labor hours used in production, and our predetermined overhead rate for this instance is $2 per direct labor hour, then our total overhead applied is $2 times 1,000, basically direct labor hours, rate per direct labor hour, equals $2,000 applied overhead. Now, the difference between applied and actual, when we get into actual in a little bit, applied is only in reference to an estimate. We are estimating this. Actual is the actual amount, but applied is estimate. So if you want to put applied overhead or estimated overhead, more power to you, but the book, and mostly when we reference this, is going to be applied. So our journal entry is usually going to be a debit to the WIP account and credit to factory overhead for the overhead amounts that are applied. We're going to get into more with the actual journal entries later in this video, because we're going to go right back to our example right here. So Road Warriors, their managers came together and they're going to use direct labor hours. Now, at the beginning of the period, as we go through the cycle, they actually estimate to do all these security jobs, custom jobs, it was going to cost them at $200,000. And the estimated direct labor costs were going to be $125,000. So again, we estimate both. So with this, $200,000, sorry, left off a few zeros, divided by 125,000 equals to 160% of direct labor cost to get to our actual overhead. In March, 4,200 of direct labor costs were incurred and noted below. Overhead was computed using the 160%. Now, right here, we took our direct labor cost. Again, we can find those right here. This is where we actually trace direct labor to each job. So with that, we took these and basically times by 1.6 for each job. So now we know exactly what happened with that job. 1.6 times 1,000. So using this applied over here, step 2, we have 1,600. Same thing, 800 times 1.6, 1,280. Now notice that we actually did use the predetermined rate, now in basically a decimal form. And I mean, if you have trouble converting percentages to decimal, just remember from here, from the end of a percentage, just move wherever the decimal is to the left 2 times. Okay? So, for road warriors, they're going to multiply each one and then take the total. That total is going to be 6,720. So, we're now going to move that overhead to work in process inventory. And then we credit factory overhead. So right now, it's basically a credit only account, but factory overhead is still an asset. So we know we need to fix this up because it can't be just credit. So again, now our work in process though is complete. So if we went all the way back up here, we have now moved direct materials over, we moved direct labor, and we have moved overhead cost. So now they're all into the WIP account. So let's go ahead and start fixing our overhead though, because it has the estimate. Now we can put in that actual overhead. So with the actual, we're going to be going through the job, and during the job, actual overhead charges will start becoming known. So for example, we will get the actual utility bill. We'll get what the indirect labor and materials were actually used on the job. How much did they cost? And then we get to consider in its actual overhead. Because the actual overhead costs now will be known, we have to adjust factory overhead due to that. So we are adjusting to reflect actual overhead costs incurred, usually done at the end of the year. Okay, so we apply estimate overhead cost to jobs, which could be larger or smaller than the amount that actually happened. Mostly, if we didn't do this, we would actually have inaccurate overhead costs being applied to jobs, which would make cost information unreliable and can influence how the manager's decision making happens. So with this, we definitely want to make sure we do everything by the book, have the estimate, then adjust to actual. We want to get to what really happened. So when the manager looks at the report and they see that overhead was off by so much, they can actually determine when another job similar to it comes, especially since this is custom, to either go to change it up, to order less, or to order more, and see what they can do to reduce cost. Because again, it's all about making the money. Alright, so how do we do this? Well, for our actual overhead, we start with step 1. We record the actual overhead that has occurred. Now, looking at the good old famous T-chart, this helps you out. Actual cost will always be a debit to factory overhead. The applied will always be a credit. Again, we have estimated applied went to WIP, actual cost has now come home. For the accounts that we deal this with, all these journal entries, we're going to 1, we debit our factory overhead and we credit the account related. So if it's materials, it's going to be raw materials inventory. If it's labor, the indirect labor, that goes to factory wages payable. And for all the other ones that deal with overhead, like depreciation, utilities, they will all get put in either payables or accumulated depreciation. Anything that basically goes out that way for factory overhead. Again, we're going to show examples of these journal entries in just a little bit, so don't worry if that just sounds very confusing to you. We will have examples. Step 2 is we're going to actually adjust overhead to reflect actual overhead. So when we do this, we apply the estimate overhead to the jobs, we credit the factory overhead like stated before, and then we record actual overhead by debiting. So when we actually have this, we're going to have one that's going to be greater than the other. We're going to take the difference and we're going to make that journal entry as required. If our debits, so our actual cost, ends up being greater than our applied, then basically our overhead is under applied. Means we just did a poor estimate. We probably had more cost than what we actually think. Maybe some materials that were indirect cost more than what we did, or some labor hours happened a little bit more. Apparently, means some of our maintenance guys had to go overtime, or something happened. Basically, the bills were more than what we expected. It happens. So our journal entry, basically to get overhead down to 0, we're going to take cost of goods sold, and we're going to debit for the amount of difference, and then credit factory overhead. That should balance things out. Well, the same thing happens in reverse. If somehow my applied is better than my actual, we basically overestimated. We over-applied our expenses. So when that happens, we just basically take a debit to factory overhead for that amount of difference, and then we credit cost of goods sold. So in reality, we are adjusting factory overhead and at the same time adjusting cost of goods sold to the proper amount of expenses that happen related to producing that product. So again, we keep this basically for the end of the year. Makes life a little bit easier. Okay. So like I said, here we are. Here's our examples. So again, related to the Road Warriors, first one was that indirect raw materials, which we already knew was about 550. So we debit factory overhead and we credit raw materials inventory, again, for 550 bucks. We next record the indirect labor used during the period. So with the indirect, as we noted, was 1,100. So we take and debit factory overhead. We credit factory wages payable for that amount. But here comes the other one. Okay, so we know the factory is going to have other types of overhead costs. One is depreciation of factory equipment. One's rent on the factory. Again, utilities that had to deal with the factory. And insurance on factory and other items. So again, our product costs that are indirect, that are non-traceable, are going to be in this journal entry right here. I would suggest probably to put this as just one big journal entry, list all the other accounts that are associated with the factory overhead, but if you do want to do separate ones, that's perfectly up to you. It works either way. Just remember to follow this. You debit factory overhead and you credit whichever account it is. For us, depreciation, again, it's accumulated depreciation, and make sure you label it for the factory equipment. We credit rent payable. We credit utilities payable for our expenses that we had. And we also credit prepaid insurance for that insurance on factory. And we'll keep going for other items that are not related to indirect labor or indirect materials. So we will have this kind of journal entry. Again, first one you want to start with are your credits, and then total them up, and that will get you to your factory overhead that you debit. Okay, rock on. So next we're going to adjust our factory overhead. So we did all of our actual costs. Now we move to basically to see which one beat out the other. Well, we knew that they had 200,000 applied for overhead jobs, but they found out that their actual was 200,480. They were close, but not close enough. So we have 480 debit. Again, the difference between those two, but seeing it as this is actually greater, we know if we look at this chart that we have under applied our overhead. So we're going to be looking at this journal entry right here. So with that being said, we're going to take that journal entry and we're going to take the difference. So cost of goods sold gets debited for 480, and then factory overhead gets credited for 480. So if we keep the T-chart, we're going to end up having 480 right here after this adjustment, and it should balance out. So again, at the end of the year, we want to make sure factory overhead kind of goes to 0. So with that, that's it of the big 3. That's how we actually account for the big 3 when we're looking at job costing, or basically any kind of journal entries related to the big 3. Well, now we move to when the jobs are done. So again, we basically did all the journal entries to take them all to work in progress. Now we're moving to finished goods inventory because now they're going to be complete, and then move to cost of goods sold to finish it up. So when goods are completed, first off, when we get that final document that says we've done everything, we built it, it's good to go, we're going to move what's in process, so from our WIP account, and we're going to move it to finished goods. This shows signs that everything's done. We're only going to bring in the costs that have incurred for that job. So for this job, at the end, after everything was said and done, cost us $20,000 to actually do. So again, we'll debit finished goods inventory of $20,000, credit work in process of $20,000. That's good. Job is complete. Now, job gets sold. So with that, we're going to take the job and we sold it to the customer for $25,000. Now realize this, most companies are in for a profit, so hopefully our sell is going to beat out our cost. Doesn't always happen. Sometimes we do have to sell it below cost because it's just been sitting there, and so it will still follow basically the same process that we're doing right now. So first is to sell the job. So when we sell it, most likely the customer is going to have it on credit. We want to bill out the customer. It's a lot easier just to bill out the customer the job that actually happened. So that means we're going to debit accounts receivable of $25,000, and then we're going to credit sales of that $25,000. Again, this is recording our revenue. So we build out a client, we're recording our revenue, and again, using the basic principles of accounting, we have that revenue recognition, expense recognition. So every time we have a revenue, we need to recognize the expenses associated with it. So that finished good is no longer in our ownership. It has been sold to the customer. Customer takes ownership. So we need to take that off our balance sheet and put it to our income statement. So, doing so, we're going to credit finished goods inventory of that $20,000, and then we get to debit cost of goods sold of $20,000. Now, at the end of the year, due to the adjustment of factory overhead, cost of goods sold will be adjusted to the correct amount. Here, we just deal with whatever's in finished goods inventory. No questions asked. Okay? So, that's the basics of Chapter 15 when there's a custom job. Chapter 16 is going to throw a little bit more twist to us, so be prepared. But that's it for Chapter 15. Let me know if you have any questions. I'll be more than welcome to actually answer any of them. Okay?